Well, thank you everyone for joining us this evening. My name is Caitlin Johnson, and I am the Director of Alumni Engagement at the Ross School of Business, and very glad to be with you all this evening. Today, we are going to hear from two great speakers. We have Nejat Seyhun, who is the Jerome B. and Eileen M. York Professor of Business Administration and Professor of Finance at Michigan Ross. And we also have Daniel Raimi, a lecturer at the Gerald F. Ford School of Public Policy, a faculty affiliate at the Energy Institute, and senior research associate at Resources for the Future. A few housekeeping things before we get started. Want to just note that this is brought to you by Alumni Advantage Remote, which are the benefits that our Michigan Ross degree holders get as alums, but we are excited to welcome this up to other colleagues and faculty, staff, alumni, students across campus today. Everyone is muted and videos are not shown for all of the attendees, so feel free to use the chat feature, shout out where you're from, any comments in there, and then we also have a Q&A feature through Zoom, so feel free to submit questions throughout the conversation and presentations, and at the end we will have a current student from the School of Environment and Sustainability and Michigan Ross, John Newman, who will moderate the Q&A at the end. So feel free to submit those and we'll be tracking those as we go on throughout. But it is my pleasure to introduce Nejat, and I will pass it off to him to start the conversation. Nejat, one moment, let me pull you up here. And we will get started. All right. It's all you, Nejat.
All right, thank you, Caitlin. Welcome, everyone. My comments are based on an academic paper that I'm currently working on. This academic paper is joint work with three other colleagues, Deniz Angener, Anil Dönmez, and Ray Zhang at Simon Fraser University, all three of them. We started work on this paper at the same time as COVID started. So the paper basically looks at how insiders reacted to the pandemic. And what we try to learn is basically from insiders' reaction, what sorts of effect they expected on their own terms. So data is basically global. We have insider trading data from a lot of countries. We have their own countries' stock returns as well. So looking at this data, we can say something about the global impact of COVID-19 as best as we can. So that's what I'm going to talk about. Meanwhile, I'm going to switch the screen, if I can, to my PowerPoint. Okay, so I hope you can see the PowerPoint. So basically, when it started, when the pandemic started, there was a lot of uncertainty as to what sorts of an impact this would have. We basically had no idea how fast it was spreading, how deadly it was, and eventually what kind of an economic impact it would have. We have a lot more resolution as of now, but still, there's a lot of uncertainty as to how long it's going to last, whether there will be second, third waves, etc., whether we'll be ever able to get rid of it. So by any means, I don't mean to imply that all this uncertainty is resolved. We're still in the middle of the pandemic. Nevertheless, we hope to learn something, at least, if not the ultimate truth, we hope to learn what insiders thought about the eventual impact of COVID-19 is on their own business. one possibility is that this represents a permanent and fundamental break in global economic activity and global economic trade. Another, so that's at one end of the spectrum. At the other end of the spectrum, it's possible that this will be a huge hit, but an acute short hit, quickly reversed, and what people refer to as a V-shaped recovery to follow immediately. So these are the two extremes, and in between we have various other possibilities: a W-shaped recovery, a U-shaped recovery, a square root-shaped recovery, etc. So, why insider trading? What would insider trading tell us about how the market, overall market, or the economy is going to behave? So you might say insiders know something about their own firms, but what do they know about the economy as well? I've written a couple of papers about this topic, published in the 80s and 90s, a long time ago, in which I showed that if you aggregate insider trading, you can learn something about the economy, that these disparate insider trading signals, when aggregated, actually predict the overall stock market movements. So I basically aggregate insider trading and showed that it was able to predict a big part of future stock returns. And you can also do this on a non-overlapping basis. Insider trading in one group of firms predicts future stock returns in another group of firms. The idea is that insiders observe some signals and they don't really know what the cause of these signals may be. They may be firm-specific, sector-specific, economy-wide, and ultimately they may not be able to separate these in any way. So what they do is if they get a good signal, they seem to buy in their own firms. And in that case, if part of these signals are formed by market-wide, sector-wide events, then aggregate insider trading also cancels out firm-specific components, retains and amplifies economy-wide component. And so that's why insider trading is useful in predicting future stock market movements. And I did this also for the 1987 crash. And what I showed that the stocks that insiders bought during just 1 month in October of '87 predicted how companies did over the next 14, 15 months. So we have a lot of evidence that insider trading predicts future stock movements. As I said, currently there's a lot of uncertainty as to how the markets are going to recover, if they will recover. So there's one group of people who think that this represents a permanent break, and that what we have is a temporary respite. Anyway, so we hope to learn something about what insiders thought and what this means for the future economic development. So there's two channels here. One channel is that they see the cash flows, an early signal on the cash flows, and that's why they trade. Another channel is that they see a mispricing, that the price that they see is not congruent with what they know about their firms. If the stock price has been overreacted and fallen too much, in that case, they will tend to buy. If they have not fallen enough, they will tend to sell, even in the face of the bad news. So you can take a look at the literature. I published a paper in Journal of Business in 1988, Quarterly Journal of Economics, and Journal of Finance about these topics. Sector by sector, answer how in different sectors behave, and as a result, what you can learn about developments in different sectors. So in early January and February, markets were pretty calm. I'm going to show you the evidence, and you might be familiar with it already. So if they can anticipate the future economic impact at that time, they would be sellers. They should be heavy sellers of their own company stock. If they thought the U.S. was going to be spared, then they may not react very much, obviously, regardless of what was happening in China at that time. By March and April, so by looking at insider trading, we can also learn something about the March reaction. Stock prices fell about 35% from the third week of February to the third week of March. That's like one of the biggest one-month declines in the history of U.S. markets. So again, by looking at how they reacted to that decline, we can learn what they think about is likely to happen. So here is the stock returns to both the overall economy as well as different sectors. So this green line is the VIX, volatility index, and you can see VIX started reacting pretty much way before the overall stock market started reacting. And so we're getting some important signals from VIX that there was increased uncertainty by end of January. You can see a very clear upward trend in VIX. And by May 19, I believe, somewhere around March 19, VIX attained a peak of 85% and now started coming down a little bit. Different sectors in the US, the only thing that reacted early is the healthcare sector, and the other ones are basically pretty much calm. In fact, market was breaking new ground, new records until February 19, and then we have the break. So you can see how different sectors behaved over here. And this shows the same thing by different countries. China reacted, this is China over here, since it was affected first. Chinese markets reacted by January after the quarantine in China, in Wuhan. Markets fell by about 8% toward the end of January. And after that, China pretty much started recovering. US decline came much later. And so you can see, not only US, but also all the other countries that are quite a bit affected. Canada, Italy, Spain, Korea are included here. So they're not doing much until, again, the US market reacted by the third week of February. I'm going a little bit fast. I'm going to pick up. This is what the overall insider trading patterns show. So there's some increase. Energy is one of the ones that insiders have reacted positively. They thought that the stock price reactions in energy were overdone. And by March, energy is basically reacting. Finance and energy are reacting extremely positively after the stock price falls of March, between third week of February and third week of March. So here's how we're going to look at insiders. We're going to define something called insider direction. That's looking at the proportion of companies that are experiencing positive insider buying. And here is the insider reactions in different countries. Very big positive reactions in March after the price falls. I'm going to jump over some of this stuff. So here are some reactions, insider trading reactions. You can see basically some negative reactions in different sectors here. Here's energy over here. This is early, until February 19th. So again, insiders are anticipating that there might be some eventual negative. So business equipment and energy are showing some declines early on. During the crash, February 20 to March 20, you can see everybody's reacting positively by this time. So overall, insiders thought that the stock price reactions of late February to late March were overblown, that this is too much of a reaction based on their own expectations. So if anything, this is consistent with a fairly quick recovery, something close to a V-shaped recovery based on insiders' reactions. And you can see also, subsequent to the crash, insiders continue to buy stock in their own firms. Again, this is consistent with fairly rapid recovery as far as insiders are concerned. When we look at different sectors, again, certain sectors stand out. Healthcare reacted negatively before the markets declined, and positively after the markets have declined. So finance is reacting very positively. Different size firms, you can see small firms have basically insiders in small firms thought they were more vulnerable, and they reacted, as well as the largest firms, trading firms, reacted the most negatively to pre-crash period. During the crash period, everybody is basically reacting positively, buying. So this is basically a regression analysis, controlling for book to market size, leverage, etc. So even after controlling for those other determinants, we see that insiders have reacted positively following the crash period to their buyers, meaning that they think this is overblown. We looked at other firm characteristics as well. And insiders in value firms, these are the value firms, are reacting positively to the crash. Market size, there's some negative relation, as you can see. Leverage, and is also highly leveraged firms are reacting more positively. This probably has something to do with the Federal Reserve's support of the economy. I'm going to jump over these numbers. Basically, I'm going to conclude at this time. There's lots of details here. I'm not going to show you all of these. So let me go to conclusions. So we're still in the middle of a pandemic. Nothing is resolved completely. Nevertheless, we've seen also one evidence that I didn't show you here is that those firms that insiders bought in March did much better in April. Those firms that insiders sold in March did not do as well in April. So insider trading, even early on, was predictive of how those firms were going to do. So even though we have a very short window at this time, insiders' reactions so far are congruent with the market reaction, subsequent market reaction. So they have predictive value, even though we have a short window. All right, so we're able to make some observations, unique, I think, and very interesting observations about the eventual impact of COVID by looking at insider trading. So basically, this evidence suggests that insiders are not putting a lot of weight on sort of doomsday scenarios for the US economy. And overall, they think that the 35% reaction was too much of a reaction. If anything, insiders are expecting basically a rapid recovery, something closer to a V-shape than all of the other more serious scenarios. So firms that were larger, value firms, firms with higher levels of leverage, firms in finance, energy, and consumer non-durables are showing greater reactions, saying that the stock price in their own sectors have fallen too much. And as I just said, those firms that have been sold by insiders have not done as well. Those firms that have been purchased by insiders have also outperformed so far. International evidence is also very much consistent with the US. That we have similar patterns in Canada, Italy, Spain, South Korea. Insider purchases, insiders have followed these big stock price declines with purchases in these countries as well. And the only exception is China, but we know that the stock price patterns in China were different as well. China declined a little bit in January and began recovery. So you don't expect a lot of sharp reaction by insiders to the Chinese stock market. So we also saw that there was a little bit of an anticipatory insider selling in January and February. So they did expect, even though market wasn't reacting, they expected some negative hit. And as a result, we found some evidence of selling by insiders in January and February. Also, those firms, US firms with more Chinese executives with Chinese backgrounds or Chinese connections, sold more shares in January and February and bought more shares in March as well. So if they had a Chinese connection, that made them a little bit more informed regarding what was happening to the economy. Okay, that's the end of my comments at this time.
Thank you so much, Nejat. We appreciate it, and thank you for that insight. I will bring Daniel in now, and he'll kind of highlight the energy industry and what he's been seeing. So, Nejat, I'm going to stop your screen sharing to swap over here, and I will bring you in, Daniel, and you can take it away.
Okay, thank you very much. All right, so my video feed is doing a couple of weird things. First of all, I'm very pink. I don't actually look this pink in real life. Second of all, there's some strange colors going on there. So I apologize. For that, I'll be showing you my slides on PowerPoint, so you won't have to look at my bizarre features. Thank you so much for organizing this to the Ross School and to the Energy Institute, two really fantastic organizations. And Professor Seyhun, thank you for that presentation. I learned a lot just in that brief overview of your recent work. So my name is Daniel Raimi. My full-time job is working at Resources for the Future, hence the screen behind me. RFF is an institution based in Washington, D.C. We're a nonpartisan research institution, non-advocacy economics research institution focusing on energy and natural resource issues. And I'm also a lecturer at the Ford School of Public Policy and live here in Ann Arbor. And I am very proud of that, and also proud to be a faculty affiliate at the Energy Institute. So I've begun sharing my slides now, and I'm just going to talk for maybe 10 minutes about what we've seen over the last, let's say, few months in the energy sector, of the effects of the pandemic and the associated recession. And then I'll talk a little bit about some of the implications for the future. And then finally, I'll zoom in on the oil and gas sector, which is my main area of research. So the first thing to say about the effects of this crisis on the energy sector is that they are unprecedented in modern times. This is a chart from the International Energy Agency that they released, I want to say about a month ago, maybe a month and a half ago now, that shows the annual percentage change in global energy demand every year from 1900 until today. Essentially what you see on this graph is that the last time we had an energy demand shock this great was in the 1940s, at the end of World War II. There have been some other energy demand shocks of this magnitude in the past in terms of percentage changes. But if you just look back to the financial crisis in 2008, 2009, there was only really 1 year where energy demand globally actually declined, and it only declined by about 1%. The dramatic effects that we've seen of this particular crisis really dwarf anything that we've seen in recent decades. So a 6% decline in estimated global annual energy demand this year. And that's across all types of energy across the entire world. So that's the first thing to say about this crisis. And that has obvious and profound implications for anyone who's in the energy industry. The International Energy Agency also made a variety of estimates, again, in this report they released last month, about how the contraction in global economic activity would affect different types of energy sources. So this is a chart that sort of shows the breakdown of that estimate. And of course, there are deep uncertainties here, not just within the long term, but even within the short term. We don't know exactly how things will unfold in the coming weeks and months. But this is the estimate that they produced based on, I think, reasonable assumptions. The starting point, if we work from left to right on this graph, is that global GDP is projected to decline by something like 6%. Again, this estimate is maybe a month or so out of date, so there may be some new estimates from the IMF and other organizations. But as with most things related to energy, total energy consumption often tracks gross domestic product or other metrics of economic activity. And so the IEA estimates that global energy demand is going to decrease by about 6%. The largest hit is experienced by oil. That's not a surprise because oil is the primary fuel that's used for transportation around the world. And when people aren't traveling because they don't want to get on airplanes or they don't want to drive across long distances, then oil demand suffers. That's why we've seen such low oil prices, including this sort of amazing phenomenon of negative oil prices briefly for a particular US type of oil in a particular place that got a lot of attention, I think back in March, maybe April. So oil demand's taking a particularly big hit, and I'll come back to oil. Coal demand has also declined dramatically, and that's mostly because global electricity demand and manufacturing has taken a big hit from this particular recession. Coal is mostly used for electricity generation, but it's also used in steel making, cement making, and other industrial processes. And so that explains the big decline in coal. Natural gas has experienced, or is projected to experience, a 5% decline this year. And natural gas is used very broadly across the economy. Whereas coal is more concentrated in the electricity sector. Natural gas is used for electricity around the world, but it's also used for industrial manufacturing. It's used for heating in homes and businesses. And so it's experienced a little bit less of a shock, mostly because natural gas demand elasticities are less than they are for coal. Nuclear energy and renewables are projected to change a little bit, with renewables maybe even increasing a little bit. For renewables, the story is a little bit interesting. Renewables are projected to continue to grow despite the fact that everything else shrinks. That's because renewable electricity generation, it happens regardless of what the price is on the market. Anytime the wind is blowing or the sun is shining and you have a renewable electricity facility that can generate wind or solar power, that facility is going to run. And that's what's happening here. Importantly, because renewables increase, nuclear decreases by just a little, and all the fossil fuels take relatively large hits, global CO2 emissions are projected to decline substantially. And I should actually say the main driver of that is the simple fact that global energy demand is declining substantially. The world gets about 80% of its primary energy from fossil fuels. And so whenever total energy consumption goes down, CO2 emissions will go down with it. So that's the very short term. When we think longer term, there are really big questions. First, the pace and scale of the economic recovery will be the main driver that dictates the fortunes of the energy sector in the years ahead. If there is a V-shaped recovery, as Professor was describing, global energy demand could rebound relatively quickly. If the economic recovery is slower, then we would expect energy demand to grow slowly as well. Governments are considering how to invest to rehabilitate their economies. If governments make investments in green stimulus measures, so-called green stimulus measures, that could bend the curve, as it were, in terms of the energy mix and greenhouse gas emissions. But it's important not to overstate the likely effect of those government investments. Government investments could make a difference, particularly in the long term, if they're investing in research and development or deployment of early stage technologies. But it's unlikely that those government policies are going to have a really big effect in the short term. Third, behavioral responses are going to matter in terms of the energy sector. For example, will people not want to get on buses or subways or other types of public transit in the future? If they don't want to get in those forms of transportation, they're more likely to use their cars, perhaps take an Uber, which will mean that total energy demand will grow and emissions will grow as well. And finally, businesses around the world might prioritize resiliency over efficiency. So instead of trying to do procurement in ways that really prioritizes getting something to your door the day you need it, companies may stockpile more. And that actually has the potential to increase energy use and emissions as well. So for the last couple of minutes, I'll just make a couple of points about the oil and gas industry in the US in particular. The oil and gas industry has been hit particularly hard. I mentioned oil prices a few minutes ago. The effect on jobs in the domestic oil and gas industry has been dramatic. These are two charts that basically illustrate that point. The chart on the left shows that oil and gas employment in the United States in May was at its lowest point since 2006. That's pretty remarkable since the shale revolution has truly revolutionized oil and gas production in the United States. The second chart that's on the right is the monthly change in employment in the oil and gas sector. There's two particular types of oil and gas sectors included here, but we can basically think of these as two metrics indicating oil and gas employment. You can see that the decline that we've seen just in the last couple of months dwarfs any declines in employment that we've seen in previous years. And that's notable because the oil and gas industry is famous for having booms and busts, as they're often termed. And this particular bust is deeper than any we've seen, again, in modern times. Whether it will be able to return quickly to pre-bust levels is a function of how quickly the economy recovers, as well as the other factors I mentioned a few moments ago. Now, finally, I just want to mention a couple options that exist here in the United States that can support oil and gas workers and communities while also actually reducing pollution at the same time. These are the types of win-win situations that I think are quite appealing. First, there is an option for the federal government to spend some money in the near term, perhaps in the next round of stimulus or recovery, to plug what are called abandoned and orphaned oil and gas wells. This may be an unfamiliar concept to many of you, but there are actually hundreds of thousands and probably millions of abandoned oil and gas wells scattered around the United States. They pose a variety of environmental hazards, including methane emissions, which contribute to climate change. You could actually plug a lot of those wells, tens of thousands or hundreds of thousands, in a relatively short period of time in a way that would reduce local and global pollution, and also put tens of thousands of oil and gas workers back to work when they badly need that work. So that's one interesting idea. Another idea that is currently being implemented in Canada is the federal government could consider loaning funds to oil and gas companies to upgrade their equipment. And the goal of these upgrades would be to reduce methane emissions. Methane is essentially the same thing as natural gas, but if it leaks out of a pipe or out of a well, it has dramatic climate change impacts. And so if the federal government loaned oil and gas companies, perhaps at a below market rate, money to fix their equipment, to reduce these methane emissions across the value chain, companies could invest in those upgrades in a way that would, again, put oil and gas workers back to work, would reduce pollution, and in addition, it would help companies make more money because they would have more natural gas in their pipes that they could later sell. So those are just a couple policy ideas that are floating around. I actually presented to the US House Natural Resources Committee a couple weeks ago on this idea of orphaned and abandoned oil and gas wells. So I've been focused on that the last few weeks. But those are a couple ideas that I'm thinking about where we could help the workers and communities that are negatively affected by this particular crash, but also provide some environmental benefits along the way. So I'll stop there and happily turn it back to Caitlin for a Q&A.
Great. Thank you so much, Daniel. Appreciate it. And I'm actually going to bring everyone in here now. So we have Nejat back, and I'm going to unmute you, Nejat. And John bringing you in, who's going to moderate our Q&A. So thank you for some of the submissions. Feel free to add any additional ones that you may have. And I will let you three start in on the conversation.
Great. Thank you so much, Caitlin. And thank you, Daniel and Nejat, for the presentations. Really appreciate you taking the time. We'll start with a question for Nejat here. And it's a question about if your analysis has been performed for past economic contractions, and to what, and if that, if it's been done to validate to what degree the insiders were correct during those events.
Okay, before I answer that question, I saw a couple of other questions. I think I should answer those, even though I don't know who dismissed these questions. One of them is, where can we get insider trading information? The other one is, isn't insider trading illegal in the US? So let's understand what we mean by insider trading, and then we'll talk about whether this analysis has been replicated and is it reliable. So when I say insider trading, we're looking at just buying, open market purchase and sales by top executives. This is not illegal. So insiders are not supposed to be trading on material non-public information, but the way the courts have interpreted what material non-public means is that they can still trade profitably. They just cannot trade immediately before important corporate announcements. So if they can't just buy before they announce some good news or sell before they announce some bad news, that would be illegal. But otherwise, just buying and selling based on their overall anticipation of future of their own is not illegal. So we call this actually legal insider trading. Second is, where can we get insider trading? You can get insider trading from EDGAR, which is the SEC's data gathering operation. So if you go to sec.gov, there you can look at corporate filings. Insiders have to report everything electronically within 1 day. So my analysis, I was the first to publish on aggregate insider trading in the 80s and 90s, and a lot of other people have followed up on this one. So yes, there's lots of evidence that, for instance, for the great financial crisis and etc., that shows aggregate insider trading is able to predict future direction of aggregate stock returns. So Lakanishak and Lee has a paper. Others have papers as well that show aggregate insider trading is informative. Lee and Lakanishak papers, I believe, is 2001. And since then, so this is not much in dispute that insider trading is able to predict future stock returns.
Great. We have a couple questions for here. I think we'll take James and Samir's questions together because they're very related. Would you expect the collapse in conventional energy source prices and also to positively or negatively impact the growth in renewables? And also, what do you think the long-term impacts of that are on the oil and gas industry as a whole?
Yeah, it's a really interesting question. And anytime we start thinking about long-term impacts in the energy sector and long-term energy prices, there just has to be a giant I wish I could put a big asterisk over both of my shoulders so that we're clear that energy prices globally are so dictated by what's happening in the global economy, which of course is very difficult to anticipate in the short term and in the long term. And so the fundamentals that will be driving energy prices, certainly in the short term, will be the economic recovery. Whether the collapse in oil prices will have a substantial effect on renewables in the short term, I think the direct effect is little. oil and renewables mostly don't compete with each other. If we think about wind farms and solar farms, they generate electricity, which we use in our homes and our businesses and industrial processes. Oil, as I mentioned earlier, is mostly used in transportation. And so when the oil industry takes a hit, it doesn't necessarily benefit renewables per se. That's a little bit less true for natural gas, but that's certainly the case for oil. When turning to the sort of second half of the question, if we think about the long-term implications for the oil and gas industry of this particular recession and the pandemic, there certainly is the potential that today's low oil prices will deter investment in future oil and gas supplies. That's certainly happening now. You see companies around the world reducing their spending programs and cutting back in a variety of other areas. And so it's likely that there'll be less oil and gas investment, which means that 4 or 5 years down the line, there'll be less oil and gas supply from, let's say, deep water resources in Brazil or in the Gulf of Mexico or in other relatively high cost areas. One of the really interesting things here is that the shale oil production that is happening almost entirely in the United States can respond more quickly than so-called conventional oil supplies. And so if oil prices recover more quickly than we might expect, then drillers in the Permian Basin in Texas or the Bakken in North Dakota or other parts of the US, they can return to increased production within a period of months rather than a period of, let's say, 4 to 5 years, which is what the lead times are for some of these higher cost projects. And so the summary of my answer is that there's deep uncertainty here, but that there is a risk that investment in new supplies today could actually lead to higher prices tomorrow. If the global economy recovers more quickly than oil companies expect it will, then that means that there might be inadequate supply to meet the demand if people return to driving to work every day and flying in airplanes more often and using oil in other ways. So I guess I'll stop there, but those are just some thoughts on those two questions. Great questions, by the way.
Yeah, great. Another question for Professor Seyhun. Does what we see from the China data indicate that Chinese insiders are right about the shape of their recovery? This is a question from Samir.
Hi, Samir, former student. So there's less data about international forecasting ability of insider trading. We're currently working on a paper that's looking at country by country insider trading and whether they're able to predict aggregate behavior in their own countries. And our analysis shows that basically insider trading is just as informative in different countries as well, including China. So I have no evidence to suggest that Chinese data is any less reliable than US data or European or Canadian or any other data. So the best evidence we have is that insider trading is quite reliable across the globe.
Great, thank you. We'll go to Daniel here for the question specifically about Colorado. Pre-COVID, local oil and gas companies were fighting mapping the wells and pipelines and doing the bare minimum with regard to managing methane emissions. I think this can relate to some of your potential proposed policies as well. During the pandemic, do you see the federal government providing funding for these purposes?
So I'm loath, again, as you have probably figured out by now, I'm loath to predict the future. But I guess I can talk about Colorado a little bit and then talk about what federal government investment might look like. And then maybe I'll offer some thoughts about how likely those investments are. So I've spent a lot of time in Colorado in oil and gas country, both on the Front Range and on the Western Slope. And, the oil and gas industry in Colorado in many ways kind of leads the way in terms of environmental responsibility and sort of public engagement. That's not to say that everything's perfect in Colorado. There certainly are plenty of problems. But if you look at the regulatory environment in Colorado, the regulators in Colorado have really led the country on a variety of policies, including methane emissions, disclosure of fracking fluid composition, and a variety of other issues. And industry, not all companies are the same, right? There's lots of different companies taking lots of different approaches, but many of the major companies in Colorado have actually been quite proactive in terms of engaging with the community and trying to deal with some of the problems that have arisen. So that's maybe a quick thought on Colorado. The federal government investing in methane abatement and other similar policies, I really have no idea if that is likely. I think, well, let me say this. I think it's more likely that the federal government would look to invest in policies that can boost the oil and gas industry largely. And if there are environmental benefits along the way, then they're happy to enjoy those as well. But given the current composition of the Congress and the executive branch, it seems unlikely to be that that policies given today's government would sort of put environmental priorities at the top. I think it's likely they would put job creation and economic priorities at the top, with environmental priorities below those.
Got it. Thank you. We'll do another question for you, Daniel, here, and get you again on the prediction game of the future.
I'm not good at it.
What are your expectations for the future of decarbonization as it relates to fiscal incentives, thinking of the ITC and PTC tax credits, potentially not getting renewed, and mandates getting deferred as governments are over indebted and companies may still be recovering from this recession?
Right. That's a really interesting question. And for those of you who are not energy wonks on the call, ITC stands for Investment Tax Credit, which mostly is a subsidy for solar. PTC refers to Production Tax Credit, which is mostly a subsidy for wind. And there's a lot of politics here in the US around the ITC and the PTC. They're scheduled to be phased out. Maybe one of them is already phased out. I can't remember off the top of my head. They're scheduled to be phased out in the coming years. I would not be surprised if an extension of the ITC and PTC were part of the horse trading process that goes into some kind of future economic recovery legislation coming out of the Congress. But I don't have any inside kind of information about that. So I really don't know how likely it would be. One of the kind of maybe counterintuitive points that I've been thinking about, and I've heard some other analysts talk about in the last few weeks, is one thing that governments are really going to need in the coming months and years is revenue, right? There is a major shortage of revenue for governments around the world, including here in the United States. So one policy that has historically been very challenging in the United States to think about and talk about, but might have some appeal in the years to come, is a carbon tax. A carbon tax has the potential to raise billions of dollars of revenue each year for the government. It's obviously not universally popular, right? There's a big political divide on this particular topic. But one of the major potential attractions to this policy is that it could provide a source of revenue for the government to continue to provide the services that citizens expect and that residents expect from the government. And so while the PTC and the ITC are, they have been helpful in some ways in spurring the deployment of renewables, the economic literature is very clear that a carbon tax would be a much more efficient and a much more cost-effective approach to reducing greenhouse gas emissions compared to the PTC and the ITC. And if you can sort of add in that extra benefit of providing government revenue when the government really needs revenue, you might be able to make a case for a carbon tax. It's not easy given the politics, but we can always hope.
Yeah, seems like as good of a time as any. Um, Another one for you, Daniel, from Jim, and I think you might have been alluding to some of this earlier when you talked about the risk of a price spike in oil and gas as we recover. But do you see that, or will major oil and gas firms have the capacity to respond to a rapidly increasing demand should it occur, given the significant staff and capital cutbacks being made today?
Yeah, that's a really interesting question. And with all the same caveats that I noted earlier, I would sort of divide that question up the same way that I talked about oil investment earlier, which is to say that there's a whole universe of relatively high cost, long lead time investment projects that are out there, that are available. We know the oil is there, but it would take years to really develop the resources in the Gulf of Mexico or off of Brazil or elsewhere. But then when you think about domestically onshore here in the United States, we also know where the resources are, the Permian and the Bakken and the Scoop and the Stack in Oklahoma, if you're into those acronyms. And those supplies could be brought online relatively quickly in periods of months rather than years. And so I would expect that the industry could scale up quickly to ramp up supply if prices were to get higher. Could they ramp up supply enough to meet a very large increase in demand? I don't know. It depends on how big of an increase in demand we're talking about and thinking about. There's also a little bit of a drag on the domestic shale production that is likely to come from financing sources. So private equity sources and other funders of oil producers had, even before the coronavirus crisis, they had been increasingly trying to tighten the reins on oil companies to show that they could be more profitable going forward. And so I think the availability of capital to US producers is going to be more limited in the future than it was, let's say, over the past 5 or 10 years. So I would expect shale to be able to ramp up quickly, maybe a little less quickly than it could have a few years ago. But again, there's huge uncertainty here. One thing that shale has done over and over and over again for the last 10 years is surprise people in its ability to outproduce expectations, whether that's natural gas or oil. If you told people that the price of if you told someone 10 years ago that the price of natural gas was less than $2 and the US was producing 40 trillion cubic feet of natural gas per year, they would have put you in some kind of natural gas insane asylum. But luckily such places don't exist, and we don't have to rerun that experiment. But so I've sort of had a policy over the last few years of, whenever people are really skeptical of shale, I just look back at the history and see that it has outperformed expectations before, and it may well outperform expectations again. I wouldn't bet any money one way or the other personally, but I'll certainly be watching.
I think we have a few minutes left, so we'll do one final question. This one comes from Carol. Will traditional energy companies acquire alternative energy firms for diversification? Or have you seen any signs of that happening yet? And what types of implications will that have for the energy market?
That's another really interesting question. I haven't followed this topic all that closely, so I only know a couple of anecdotes here. But I'll mention those anecdotes for what they're worth. There's a big division when we think about the big oil and gas companies out there, the Exxon Mobils and Chevrons of the world, and the Shells and the BPs of the world. There's a pretty big division between US oil and gas companies and European oil and gas majors. Shell and BP in particular, they have been pretty proactive in investing in new lines of business over the last several years, thinking about climate change and trying to find resilience in the face of potential government policy that makes oil and gas production less profitable. So Shell, they have a large electricity trading business. They're looking at getting more involved in electricity generation, I believe. They're looking at electric vehicle charging. I think they've invested in some companies that do that. BP is kind of proceeding along a similar track. The French oil and gas company Total, the Italian company Eni, they've all made investments in the lower carbon kind of segments of the energy industry. When we look at the United States, ExxonMobil and Chevron and some of the other large producers in the US, there's less of that activity. And there's been a focus from those companies on natural gas as a substitute for coal, which is lower emitting than coal. Even if you account for methane emissions, the best research shows that it is still lower emitting than coal. But they have not ventured into sort of low carbon electricity in the same way that some of the European majors have. Some of these companies have biofuels programs to try to produce biofuels that can be used in, let's say, transportation in the future. But when you look at their investments in biofuels relative to their sort of core business, they've been pretty static over time. So those are my thoughts on some of the big companies here in the US and abroad. But we'll see what the future holds.
Thank you.
Well, thank you. Thank you so much, everyone. John, for moderating the Q&A, and Nejat and Daniel for providing just info and facts and figures on what's going on. I know a lot of us probably feel like it's sit, wait, hope things improve, hope things get back to normal. So we appreciate kind of the point of view from you all, and sharing. Our faculty and lecturers are fabulous. It's something that we haven't had the opportunity to do, broadly speaking, but this virtual world enables us to come into your homes across the globe. I know I saw some people from Brazil. We had, Ann Arbor, that was Daniel. New Zealand. So it's fun to see all these different folks who we wouldn't be able to connect with otherwise.